Every great company starts with somebody having a bone to pick with some big problem. In the pain of the $34 overdraft charge on a cup of coffee, we look at your cash flow data, not your credit score, to offer you a $75 microloan. And we went from being a $5 billion company to a $50 million market cap company within a matter of 9 months.
Today on Billions, I'm sitting down with Jason Wilk, four-time founder and the CEO who took a 98% stock collapse and turned it into one of the greatest comeback history in FinTech. His first company, Gold Club for a dorm room. His second, a NatTech playout of Y Combinators that sold for $85 million. He used that money to start a war against one of the most predatory fees in American banking, the $38 overdraft charge that quietly bleeds $30 billion a year from the people who can least afford it. He called his company Dave, as in David versus Goliath. Jason, welcome to Billions.
Thanks so much.
Can you maybe explain to people why you decided to start Dave in the first place?
Personal pain point. I think every great company starts with somebody having a bone to pick with some big problem. And for me, that was going through high school, college, starting my first business, and the pain of the $34 overdraft charge on a cup of coffee or a tank of gas was just incredibly punitive in a time in your life where you need every penny counts to make it through. And I knew if I had that problem, there were lots of other people that might be having the same issue. And it turns out it's over half the country is dealing with things like overdraft fees, not having enough credit score to afford mainstream credit products. And ultimately just the banking system is too expensive for the everyday American.
So how do you attack such problem? Because, it looks like a banking system is huge. How do you get started with it? How do you create your new bank?
I think the way we started actually led to a lot of our success in the sense that I knew we always wanted to offer a full suite of banking services, but to offer that back in 2016, it would have been a tremendous amount of work to either get a bank charter or go through the bank partner process. At the time that Dave was launching, there had been several neobanks around previously that had not really seen a lot of traction. And so I had in the back of my mind that people's excitement to open up a checking account was really not there, but their pain point around short-term credit was. And so we decided to start with that part of the spectrum first. And so a company launched in 2015 called Plaid, which was the conduit between fintechs and large banks. And there was only one interesting company that was using the service that I had seen so far, which was a business called Acorns, which was connecting to your primary checking account, looking at your transactions and rounding up your purchases to put into the stock market. I said, that's really interesting. If we could use that same cash flow data to underwrite people for effectively a microloan in the US, that should eradicate the need for traditional overdraft. And so Dave's first product was a app where you connect your checking account. We look at your cash flow data, not your credit score, to offer you a $75 microloan, smallest loan in the country. And this model had worked in places like India and Africa where microlending was a real thing, but no one had really tried it in America as a way to solve sort of short-term gaps. And the real vision there was that short-term credit of this small dollar amount, FICO is an irrelevant score because that's based on long duration credit, your ability to pay a mortgage or an auto loan. And we've really proven out that your cash flow data in your account is very, very valuable. And I knew that to be true because I always knew my paycheck was coming in. I was a great customer for my bank, but why charge me such a high rate when they know that I'm good for the money? And so that was really the foundation of the business. Start with the credit, migrate to banking later. And we've really followed along that journey. We didn't launch banking really until 2021, where people could make Dave their primary account and should they choose.
And can you maybe walk us through the equity story? Did you have to raise funds in the early days? Who were your investors? Was it easy?
The seed round was fairly easy because I utilized most of my investors from my previous company. One of our investors, I had a deal with that whatever they made in the previous company, they would automatically write me a check for the next company, sight unseen, for 50% of whatever their profit was. So that check was real easy. It turned out really great for that guy because he never would have written that large of a seed check usually. And it's, I think that stake's worth over $150 million now. So he's done quite well. And then two of my other lead investors from my last business also participated. We rounded out the group with Ron Conway and SV Angel, among some other people in the seed round. But that was a $3 million round, which we used basically to buy the domain name, give us some capital to hire the early team. And also we needed some principal capital to actually lend out to users because we didn't, at that point, had no credibility with private credit, and certainly no bank was going to be willing to lend us money with no experience.
And the second round, like how exactly did it go? Like, did you feel like you had to work a lot harder, or like?
The second round was really difficult because we clearly had product market fit. Customers were loving the product. We were scaling. Our CAC was really low, but our loss rates were really high. They were like 20%. And so it wasn't quite clear that the this customer profile that we were underwriting was going to be able to lend to profitably. And so we had that going against us. And also every venture capitalist, at least that I spoke to, had never really even heard of overdraft fees. So they didn't recognize it as a major problem. And the third was that neobanks historically had not gained a ton of traction. The most successful exit thus far was, I think, Bank Simple, which sold, I think, for $150 million. So, not great comps, not great loss rates, problem that investors don't really understand. And it took me about 120 meetings to get the Series A done. And ultimately, it was with an investor that wasn't even in writing checks into FinTech. It was just a connection with one of our board members who said, trust me, it's a smart team. Jason's hardworking, he'll figure it out, as he always does. And so that really was the catalyst of getting the check there. We had a tremendous performance from that $10 million check. We got loss rates down to a few percent. We were scaling users. We got to, I think, close to 1 million users in the first couple of years. And we didn't raise our next round of funding until we reached $1 billion valuation in 2019. And that was a big deal because there weren't that many unicorn businesses back then. We weren't in a hurry for raising more capital, and so we could be more patient. But the traction we had at that point was sort of irrefutable at that point in time. And so raising the round was a little bit more competitive. And we brought on a great investor, Norwest Venture Partners, who led that round entirely. And that $50 million equity check lasted us all the way to the IPO. So it was incredibly capital efficient. I think around 63 million of total primary capital raised. And the next round was our public transaction.
How exactly do you like prepare for an IPO, and when do you decide like if you're ready or not?
Well, we were really quick towards an IPO, and more so than most. I think as of January next year, we'll have been a public company longer than it being a private company, which is really interesting. And so it's almost like we've forgotten life as a private business and don't miss it that much. And to be honest, we like the rigor of the quarterly reporting. We sort of got ourselves in this quarterly reporting mindset leading up to the IPO. And fortunately, what gave us a lot of confidence is our business is very forecastable. We have a lot of cohorts that have been with us for a long amount of time. We have a very heavy repeat users, and we thought the business was ready, even though we were early on to become a public company. As of January, we'll have been a public company longer than being a private company, and don't really miss it that much because our business is a lot of repeat customers. And so we feel like we can forecast the business really, really well. I think that's a key for a public company. And investors want to be able to build models they can rely on. And given we have 98% of our customers every month are our repeat users, we just felt a lot of confidence in the core model. So aside from that, just building up the management team, getting the public board ready, and then going on the roadshow process to find our lead investors is not too dissimilar from a private capital raise, other than you have to convince 50 people to validate your valuation as opposed to one. And I think that's a major difference in public versus private. It's just your valuation in public is more consensus versus private is literally can be just the opinion of one person.
And how long did it take you from, okay, I think we should IPO to let's ring the bell? Like, what was the timeline?
Well, the market was ripe for IPOs. We were marching our way there. We thought we had a great opportunity to go public. decided to wait a little longer to see how the market was gonna continue to play out, and ultimately decided to go public in January 2022. The market looked a little soft when we went out, but we had a great IPO. I think we were the best performing stock of the first couple of months when we went out. Valuation got to over 5 billion, and then the market fell apart. The interest rates went up, which led to fintech being a bad name, anything being in lending being a bad name, and then with growth capital effectively coming to a halt. If you were a company that was losing money with the expectation you had to possibly raise some more, people just underwrote your valuation effectively to zero. And we went from being a $5 billion company to a $50 million market cap company within a matter of 9 months. And we were trading for less than our cash value for a good amount of time. It was a really challenging place to be. But ultimately, we loved our business. We knew that all we had to do was grow our way out of this, which was not a really great narrative at the time. But our plan was to keep burning capital until we could actually cross the user threshold required for us to reach profitability. And to us, as an already lean business, that was really our only pathway to success, because we couldn't cut our way there like most businesses could do that. We were a very lean team. We're still a very lean team with only 300 people at the company today, actually a little bit less than that. And just we kept our heads down and got there. And here we are today, nearly $4 billion market cap. And team's happy. Investors seem to be pretty happy. And we think there's a lot of room to run from here.
Yeah, I mean, I've looked at the stock. I think it's quite insane to see like the growth you guys are doing. So congrats. And I'm
Thanks.
actually like curious to understand like when your stock start like tanking, like how exactly does that affect the company from day-to-day operation? Because you still have your customers, you still have like I mean, you're still generating cash. It's just basically like a valuation that the public market is giving, but does that affect you like from a day-to-day basis, like in like bad ways or?
Well, the only way it would really affect us if we needed to raise capital, we were dead in the water. I mean, imagine trying to raise $50 million when your valuation is 50 million. That wouldn't be a really great place to be. And so fortunately for us, we didn't need more capital. We knew we didn't need more capital, but that would have been a really tough place to sit, should we needed that. But look, taking a step back, you want to be a public company because you have public currency you can give away to employees for valuable stock options. You want currency for M&A, and then you want the ability to tap what is an easier way to raise equity capital. And the challenge we had being a public company with such a low market cap, you can't take advantage of any of those things. So really, it was like a waste of time and money. It cost, at least a couple of years ago, close to $10 million just to maintain being a public company. And so you want to have those benefits. Otherwise, there's not really much of a point.
And from like from your side, like because when the valuation of the company is like at a certain like is getting like lower and lower, does it make the company like a target for acquisition potentially, or like because if you see a company that's actually like valuable and you see like their stock price going down, you might want to acquire it, at a much lower price. Like, is it something that, when we talk about hostile IPO or this kind of thing, like,
I'd say that's the one, big benefit from going public was that my shareholders gave me a different share class. And so my stock converted into, controlling vote, which when you have that, it keeps a lot of the activist shareholders away or any hostile takeovers. It would have been very easy to build a position in our company and, try and acquire it. But the fact that I had the ability to approve any M&A through my control vote kept a lot of people, on the sidelines. And so that was a big benefit of going public, and, would recommend that for other founders who are going out. It's in many ways in the best interest of the company.
oh, yeah, that's super interesting. And I think like Tiger at some point was part of the one, like helping you to go public and investing in when you started the IPO. But usually these investors, they have some sort of like lockup period and they have to kind of like keep their shares for a long time.
That's right.
And in their case, I think they decided to sell at some point. Like, can you explain a bit like how does this work and how can an investor who has a lockup period is actually like able to do these kind of things?
Yeah. So generally, you have your private investors leading up to an IPO all agree to a sort of a standstill lockup provision, generally 6 months. But the investors through the IPO process do not have any sort of standstill, at least through the process we went to go public. And so Tiger and others were free to sell from day one. That didn't help us because Tiger had their own issues through April with a lot of people redeeming in their fund due to the market crashing. And so it was nothing against our business independently, but they just sold everything that was in growth. And to lose your anchor investor that quickly prior to a lockup when your valuation still has a lot of value appreciation from early people, which also put selling pressure on, it just led to a sort of perfect storm of disaster for us. And fortunately for us, it was had nothing to do with our business, but from a just timing market landscape perspective, we were in the worst of every storm.
And as the company was when it was at the very bottom and you knew that it has like tremendous potential, as a founder, like did you acquire more shares at that time, or like did you? I mean, is there a way like to benefit from it in some way?
Yeah, I mean, it's hugely beneficial actually. So we couldn't afford because the valuation was so cheap to just give people, better stock packages at today's price. But we did structure this performance stock unit structure where people actually would get more shares at certain prices, all the way up to I think the stock price got as low as about $5 post split. And the need and belief for a lot of our employees was that the stock could reach, 100, $200 worth of value. And that's like 20x return. But it's amazing to see that everyone that stuck around and got those performance units have fully realized that. And we made more millionaires post IPO because of that drop than we did pre IPO, just from the amount of people that we hired and that stuck around.
That's insane. And for the IPO, I think you did like a SPAC. Um,
Yeah.
can you explain to people what it is and like how concretely does that work?
Well, SPAC versus traditional IPO, you are effectively merging with an existing public shell whose sole mission is to go find a company to combine with. That public shell has no operating business. They have capital that they have committed from investors to go find a target. And the benefit of going public that way is that the shell is already public and you're able to negotiate your valuation and how much capital you're going to raise through your investor syndicate well before your IPO date. Whereas in a traditional IPO, you don't really know what the value of the company is going to be until you start to build your book right before the IPO process. So there's a lot to like about the SPAC and just there's a lot more certainty, especially for a young company. You want to be able to count on the proceeds if you're going to go through the process that you want to be sure is going to succeed, not fail at the end. There's a lot of IPOs that go through a testing the waters at the end and don't like what they see, so they pull back or they wait. You've seen that before with others. And so the big, I'd say that the downfall of the SPAC came from the types of quality of companies that went public. 'Cause a lot of them went out of business. Valuations were not based in reality. So SPACs got kind of a bad name, but they're still a perfectly viable vehicle based on the reasons I just explained.
And why do you think it got like a bad press at some point, like the SPAC?
Well, there's too many companies that never should have been public went public through that process. And that was just the environment of interest rates were nearly 0%. The market was super hot and the appetite for underwriting companies losing significant amounts of money with negative unit economics was, at an all-time high. And so the challenge of all these companies that weren't great is what put pressure on the SPAC process. Had we only kept it to high quality businesses, which we believe Dave was one of them, then SPACs would still have a great name, and I think it'd still be a very popular way to go public. But unfortunately, I think the negative stigma is there.
And what was your revenue like whenever you did your like SPAC IPO?
I want to say it was around a couple 100 million of a run rate at the time of the IPO, and I believe in 2022 we burned 100 million. We raised 210 of total proceeds. We had a decent amount of capital left, but if you were to just take a run rate of our burn rate at the peak, I can see why some investors would say this company is not going to actually, make it through to the end. But, we always knew that there was this pretty clear line. And once we started to get cleared towards that line and could really clearly communicate to investors that once we reached 2.1 million paying members, every incremental user was going to be contributing to profitability because we don't need a bigger team to grow the user base by, the next 100,000, 200,000 members. And now it's just amazing to see. I mean, our guidance for 2026 is over 700 million of revenue at the midpoint and over 300 million of EBITDA. And that's just a $400 million swing on earnings in just a few short years. And the investors that believed in us have made just tremendous amounts of return.
And how do you plan for it as a founder? Because we see a lot of people, raising like a lot of money and saying like, hey, we're going to reach that point where, things become like profitable and we have a great business. Like, I mean, you hear this story a lot. The truth is like very few people manage to do it. So how exactly did you plan for it? And how did you manage to really succeed?
Plan for what specifically?
Planning for like the profitability points that you would get to.
Well, I think we knew what we needed to build our platform that could scale. And to us, that was the 300 people we needed to build the core systems. It would be hard to think we could do that with significantly less people than that. And so we sort of drew our line in the sand that this is the amount of people we have. We did a hiring freeze. We didn't do any layoffs. We just said, we're going to keep it steady here, that only do backfills of people that leave, and just really kept our heads down, avoided all distractions, any new products that weren't core to achieving profitability went on the back burner. And a lot of our work went around just margin improvement, renegotiating contracts, adding more users, driving more CAC efficiencies, improving onboarding conversion and underwriting efficacy. And it was just a real big push across the company to turn profitable. I even got my CFO a hat that says EBITDA on it for his birthday. And he was really driven. Kudos to him because he was really the driver of all the profitability initiatives within the company. And we succeeded in it even more so than we could have expected at this time 4 years ago.
And as a company, and as a CEO, whenever you raise fund and you're like non-profitable and you're spending a lot on, I don't know, like hiring, on acquisition, on all of these things, like the vibe in the company is a bit different versus when you're bootstrapped and you're looking at how much you should spend. So you're always like profitable. And for you, you also went from, okay, we have money, we spend it, to we're profitable and we need to stay profitable. So how exactly did the company culture kind of change with that change?
Well, it's tough depending on what stage of the business you are at. I'd say we, in our later, potential later rounds, the fact that we were a profitably growing company meant that we didn't need to raise more capital, but also had we raised a lot more, we probably could have grown quite a bit faster. And so to attract some of the best and biggest venture capital investors in the world, they like seeing the heavy burn, right? Because they want to put more capital to work. And so we lost out on a couple of funding rounds of competitors who were burning 3 or 4 times as much as we were to chase user growth faster. But ultimately, that wasn't the kind of business we wanted to run. We had really healthy growth while maintaining profitability early on. We took the business to running at a loss to build the platform of which we believed was needed to build for the long term. But it's really a matter of preference on the founder. Do you want to raise a lot of capital and raise a bunch of pref? I never liked sitting behind a lot of pref personally because it just becomes a dangerous game of having to clear that pref stack in an M&A transaction could be quite challenging. We still see a lot of our smaller competitors who thought they were worth $1 billion. They raised several hundred million of venture capital and it becomes a curse in the end. And so I think for businesses that really need it, like these AI hyperscalers, there's no other choice. But I say for some founders, you got to really look at this VC money you're raising is like very high APR debt. I think about the effective APR we paid our Series A investor, it's worse than any loan shark in the world when you really take a step back. I mean, if I had that much confidence in the business that early on, I wish I did that $10 million round as venture debt in the business, not giving away very valuable equity in the company, which is worth, so much now.
And what's like, would you say is the biggest challenges for you, like in the coming years?
Uh, Biggest challenge for us, we are becoming a multi-product company. We just announced our new credit card. We're excited to scale that, and it's always ever easy for companies to build multiple, go-to-market leading business units, and we're just really excited about that as the future of the company. And I think that's our maybe biggest challenge is proving out our ability to have multiple things working at scale.
And on your side, like, how do you decide like to launch a new product when you have something that's already working, already growing? Is it because you want to get like more growth? Is it because you want to get better retention? Is it a bit of both? Like,
Well, one, it just comes back to what our customers want. And we have the benefit of having millions of customers. We can talk to them. And going back to my days at Y Combinator, the number one lesson from Paul Graham was always to talk to users. And we do that all the time through user research. Really important to understand what they want. We also have the benefit of having a connection to our customers' primary checking account. And so we can actually see all the products that they're using. And so that's amazing market intelligence for us to go decide what else we need to be doing. But in the end, yeah, it's building customer happiness, and if we do well there, that's going to lead to better lifetime value through either more ARPU or better retention, or both. And that's sort of the name of the game.
and is it like how exactly do you decide like about a new product? I know like you're gonna talk to customers, etc. But why did you choose a new credit card and not something else?
We wanted to lean in on where we thought our differentiation was versus our scale neobank competitors, and to us, that is our AI based underwriting of cash flow information. And it was working incredibly well for our extra cash product, which is giving people up to $500 between paychecks. The beauty of that product is the payback is very short. The downside is that the customer's willingness to use that for multiple different purchases is quite low. You tend to use our core product for gas, grocery, and rent, all these sort of non-discretionary expenses. But we aspire, and we could see through the cash flow data that our customers are using things like BNPL and some private credit card for discretionary purchases, of which we had 0% market share. And so when I think about areas where we think we have the right to win, our customers love us for credit. We think we can expand the credit, and giving them a different use case of how to use the company made a lot of sense. And so it felt very clear to us as to what to build. We just had to go back to sort of the core principles of the business of what we want to disrupt. And it is these expensive fee streams from banks and credit card companies. And just like overdraft fees are really hurting Americans, revolving credit card APRs and credit card late fees are over 100 billion a year. And so I like the idea of eating other people's margin through better products. And we're going to do the exact same thing with this product.
Yeah, and you have already like the user base, and like so it's whenever you deploy, like you're gonna have like a large addressable market from the start. So it's
That's right.
quite smart. And I was wondering because earlier you mentioned that the interest rates started to kind of change, and it affected like your company. So how exactly do you plan? Because you're essentially offering like short-term loans. So obviously you're a bit dependent on the macroeconomics. So how exactly do you plan on things that are a bit outside of your control?
That's hard because the market just tends to swing naturally from things that are out of your control every day. Things like the war impact the stock, even though that should actually be a tailwind for our business because things getting more expensive, more people turn to our products. But it's hard, in a world where the stock market is largely traded automatically at this point, it's nearly impossible to avoid being, pulled by the macro. With respect to interest rates, though, because our capital turns over so quickly, even with our new credit card product, which is a pay in forward duration, we're not really reliant at all on private credit markets or the cost at which it takes to borrow because we're not taking long duration risk. And that's one of the theses we think that investors should really pay attention to in our story is that we don't have that risk whatsoever because our average duration of credit is about 8 days, and
Okay.
the return profile we get on our credit transactions far exceeds even the highest of interest rates to borrow over the last 25 years.
So what's kind of like the default rate you try to focus on? Like what's like the highest default rate you can go to in order to have like a business that works?
Well, I think we just talked about our last earnings call. Our gross spreads on every credit transaction are over 5%, and we return that capital every 8 to 10 days. So, that's arguably our ceiling of what we could go to on credit. And if you look at our 120-day loss rate at this point, it's nearly 1%. So the spreads are there. We originate millions of these micro credit transactions per quarter. So it's very, we have a lot of visibility into performance and don't expect that to erode in any kind of cycle.
And with the new like AI models, because you mentioned that you were leveraging AI like to and machine learning, I assume, to like kind of predict, like the default of one customer, so therefore you can know like who you're gonna pay, who you can loan like money. So how does the new model like affect like your company? Is it like in a positive manner? Like, do you see your algorithm getting better like every single month, or do you see like no real impact because you already had something that was working?
It's all incremental. I mean, there's two things going on with our business. One, because the duration of these our credit transactions are so short, the models learn really quickly as to what actually works in comparison to like an installment lending business that's lending capital for a couple of years. So hard to use AI or cash flow data to predict performance because so many things could happen. The economy can shift. There can be changes in the customer's employment. But with such short duration credit, we're able to learn so quickly on what actually works to full maturity of the entire book. And that is so valuable. And so every time we launch a new version of our models, we're inputting another 100 or 200 features that we can test to see if it's incremental to credit and know within a matter of weeks or a few months the performance outcomes. And so it's just a really powerful place to sit. You combine that with the fact that almost 98% of our originations per quarter are going to repeat users. We can always start to increase credit per user just by the fact we start to know our members more. So with both those dynamics happening at the same time leads to a really stellar financial performance.
Yeah, really interesting. And on the from the team management perspective, because now I think you have like a team that is quite lean, like with 300 people and a high valuation, and a public company. Like, how exactly like do you manage like a lean team? Maybe you could give like I don't know, like some tips of the things that you've seen working well for retention, for talent retention. I mean, like for helping people grow also within the company.
Well, one, we focus on having a high quality team to start. Some people that really inspire others to want to work there. I'd say two, we have a lot of great rituals at the business. We have a recurring quarterly business review where we bring our management team together plus key directors to go over the quarterly performance and look at what's ahead. We have a very rigorous weekly business review where we're going through all of our key core KPIs in the business, to hold ourselves accountable there. And we work on having a very clear mission, vision, strategy that we communicate to the team to make sure everyone's sort of rowing in the same direction. And lastly, we use OKRs as well so that there's just really a lot of clarity around what we want to build and how that maps back to the mission of the business. So I think that's a great foundation. The fact that we're a virtual first company as well, I think really helps, especially in FinTech. We've got a great team that lives in various parts of the country, and there's a lot to like about that model. I know a lot of people are trying to go back to the office, but we feel like this is a differentiated way to recruit key talent. The people that want to be virtual first absolutely love it. And so I'm not a CEO that's out there promoting virtual first as the model, but company dependent. It works well for us.
And like what is changing, like as an employee when you go from it's a private company to it's a public company? Like, are there things you're allowed to say, not allowed to say? Like, do people who work, have like a specific like agreement that states clearly like what this can say, what they cannot say? Like, can you maybe like walk us through the different changes that the company has to undergone?
Mostly just the sensitive information. You got to trust your team's not going to, go trade on that. We have our standard quarterly blackout periods where people can't trade the stock, but ultimately we, need to have a lot of rigor around just compliance as a business, being a public company.
Okay, okay. Super, super cool. And yeah, so for you, like, I mean, I think now it's been a bit more than 10 years since you built Dave. So how do you see like the future? Like, do you see yourself as like a lifetime company? Like this is gonna be your one project and yeah, and continue forever? Or do you think that eventually in the time of a business when it's public, you might want to have like a CEO join or like someone else? Like, how do you see it?
It's too early to tell. I've been doing this for 10 years at this point, which is, yeah, you never know how long you're going to be running these things for. I think any great company takes at least 10 years to just to get it to what is a success. I think for me, it's really hard to think about building another company and like Dave of this size and scale. I think, to achieve a business that does nearly $1 billion of revenue, those don't come along every day. To build a really amazing team that you like to work with that's high performing, I don't really want to go back through that process of building the team again and going through all the different cycles of the types of teams you build because they're so different, the early team versus the team you have at IPO and beyond. So I'm definitely not in a hurry to go start another one. If anything, maybe would become an investor or something at some point. But I don't envision starting a new company. And I hope I'm working at Dave for many more years to come.
And how is your time split at the moment? Like, how much time do you spend, I don't know, like on hiring, managing the team? Like, how exactly is it split?
It depends. We're trying to hire an executive. I'll spend a lot of time on that. I'm also, help with hiring board members as well. So spend a lot of time thinking about the quality of our team, the quality of our board, the quality of our teams beneath our leaders at the company. Spend a lot of time thinking about company engagement across the board as everyone, what can we do to improve the company and the management? And it depends on the time of the quarter, but post earnings, I spend a lot of my time after the print going to speak to investors, go to at least a couple of conferences, get on the road, go speak to shareholders, some new, some existing, and then obviously spending time with your analysts too, which we have over 12 analysts. So making sure they're understanding the story and the models. There's your time really shifts. I'd say 2-3 weeks post earnings, it's very outside focused. The rest of the time is the internal quarterly business review, thinking about everything going on internally at the company. So it's kind of maybe like 70-30 internal versus external at this point.
And can you explain maybe like how does that work with analysts and like when it's like post earning, like what's gonna happen? Like how exactly does like the whole situation and stock price work?
Well, stock price we can't predict, but
Okay.
you do have your analysts of which we catch up with afterwards, and they both comment on the earnings call, but also we have private conversations with them following, and they have their key questions. Because they have each of them have built their own financial model, and so after the quarter, we sort of look at how our model compared to theirs and discuss what they got wrong, what potentially we got wrong or more right than we thought. And then they go to the next quarter and they update their numbers, update their price guide. Hopefully it's always increasing. And they update their, buy, sell, overweight rating. That's tends to be how it works with the public analysts. A lot of the buy side investors, though, are hedge funds or long onlys. They all have their own models too. So they'll talk to some of the bank analysts, but largely they're very reliant on the internal models that they built. And the same thing, we'll catch up with them to see who got what right, and they go from there.
Okay. And yeah, I'm wondering, like whenever you have like this kind of like earning calls and how exactly like I mean you've seen in some companies where the stock is basically like moving a lot and it's not really tied to the company's performance. So we can see companies, who are like still growing, still generating a lot of cash flow and getting, like a very different valuation versus what their earning shows. So how exactly do you like how do you maintain, the vision and the long-term vision as like a public company CEO when you also need to think from a quarter to quarter basis, like because I think you mentioned like structuring your board, so maybe this applies a little bit with it.
Well, one, I think you have to have a really strong core business of which, you can really see strong growth within that. And that allows you the ability to have some freedom for thinking long term about future roadmap items. Like I'll take the credit card for an example. We don't need that credit card to work for many, many years to support our longer term growth algorithm. And that's thanks to having a great core business. And I would recommend, no company go public unless they have a lot of confidence in the forecast for their core.
Okay. 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 And you mentioned, structuring your boards and potentially like having different people. So how exactly do you structure a board? Like, who do you look for? And can you maybe share like tips on how to structure like a great board?
It really depends on the business, right? And so for us, well, every public company needs a great person in sort of audit. That's fairly standard. That's going to be somebody who is a former CFO, most likely, and we've got a great one on our team. And then you sort of fill around the board of people you think are going to be helpful to your industry, your business. One of our private credit investors is on our board. We have a capital markets guy who can help us understand how to talk to analysts and recruit different new shareholders. We had a regulatory lawyer that understands all the regulatory complexities. Ultimately, you want to have people that when you spend the time to get together for these quarterly board meetings, of which last 3 to 4 hours, want to make sure it's useful. And so people you think that you can rely on for input on strategy, making sure the company is following all the rules, but it's going to be added to the business, not detracting.
And how exactly does that work? Like, do you give them shares or is it like a yearly package? And yeah,
It's a yearly package. There's some equity and some cash.
okay. And
And the
yeah,
recruitment sort of starts. You either find people that or oftentimes people will use recruiting agencies specifically for executive board recruitment. And so we've done a little bit of both.
okay. And what do you prefer? Like, do you see hiring agency working well on this side or?
I think it's always best to use internal if you can go that route. But one, not everyone wants to be on a public company board, and two, finding people with the experience, it's not always within your network. And so I found that we've had a lot of success using recruiters for board roles.
Okay, okay, okay. And is it like from like a pure like growth perspective? You mentioned earlier, that eventually, if you had raised more cash, you could have gone a little bit faster. Now you're at a stage where you're like profitable. So how exactly do you balance, that speed versus sustainable growth? And how do you envision the future? Like, do you want to keep, this very lean team and growth that is, kind of like mastered, or do you see things like in a different way?
We're not trying to constrain the team to 300 just to do so. I mean, we really do believe we build a highly scalable platform. We are adding to the team this year. We're going to go from 300 to 320, 325 ish. So, we are doing that because we believe that the investments we're going to make there are going to, lead to, significant multiples of, revenue once we deploy the products that they're working on. I'd say for us, we've had quarters where we've grown the business 60+% and have not seen our multiple expand as a public company. And so that tells us a little bit that we're not really being rewarded for growth. So to us, we really try to communicate a very sustainable growth algorithm to grow users, single mid double digits and revenue per user by low double digits. And if you believe in the combined effect of both of those metrics, it's going to be a 30% plus growing type company for many years to come. And, you know, we're, we're totally fine with that. And, if the multiple we trade off is what it is, that gives us an ability to launch new products of which we think can hopefully lead to multiple expansion from there when people realize that we can generate revenue from more than just a couple units.
I'd love to pick your brain on something. So what you're saying is like the high growth is not always like rewarded from public market. So from your side, if you had, let's say, like two companies, one company is that year one is growing, let's say 10%, year two, they're growing 200%, year three, they go back to like 20%, year four, like it always changed like this. And there is another one, company B, that's growing, let's say like 35% every single year for like 5 years. Do you think that company A will not get like uh, a higher stock than company B just because it's not as predictable?
Well, it depends because the company that grew 200%, may have some insane revenue multiple. And so I know CFOs of companies like that, and they tend to envy our position because we trade at a very modest multiple. We have every opportunity to try and do things to expand that versus they're thinking of every way they can preserve this potentially unrealistic multiple. And so I'd rather be in the more conservative world where, we have a great core business growing at a rate we feel very confident in with a model, profitability and flexibility to launch new things that can get investors excited about for future growth.
Yeah, I agree. And I know we're almost running out of time, so that's going to be the final question. What would be an advice you could give, like to anyone who wants to build a company and IPO?
Well, I'd say these things take a long time. They take a lot of effort. And so you really better love the idea you're working on. I've seen a lot of companies that start as sort of copycat businesses because it's a great place to be or, interesting space, but you've got to love what you do, feel like you have an edge, a reason for a right to win. And everyone we've seen that tries to have copied Dave in the past, most who's sold their company are fluttered because the founder wasn't in it for the mission. They were in it just to try and capture what was, the hot company idea at the moment.
Great advice. Jason, thanks a lot for being here. Where can people follow you and follow Dave's update?
You can follow Dave on X or on LinkedIn, and you can follow me on LinkedIn. Not super active on Twitter, but LinkedIn I post sometimes.
Awesome. Thanks a lot, Jason.
Thanks so much.